Well, after the biggest decline for stocks since the financial crisis, we are officially in correction mode for the S&P 500. This is the 19th correction since World War II. Sam Stovall, Chief Investment Strategist for Standard & Poor's, joins us now. Sam, you always have good historical context. So historically, were we ready for this correction?
Well, I think nobody's really ready, and that's why it takes people by surprise. This market declined 12% since the top on April 29th. So, of course, people are now thinking, gosh, I should have sold in May and then gone away. So the real question is, how deeply will this correction go, or might it morph into a new bear market?
Well, I think that is the question. You said in your most recent note, it's just going to be a matter of months before we see whether or not this is just a correction or whether we're falling into another bear market. How long will it take us to see that? Historically, what are the signs that will tell us which way we're going?
Well, historically, it takes about 9 months for us to breach that 20% line in the sand that separates a correction from a bear market. So we still have a few months to go before we at least hit that average time zone. I think certainly the real question is whether the U.S. will likely slip into a double-dip recession. With the most recent payroll report, I think investors are breathing a bit of a sigh of relief that the numbers actually came in better than expected, and prior months' numbers were revised higher. So a lot of your more traditional indicators, such as an inverted yield curve, meaning that short-term rates are higher than long-term rates, are not helping us to decide whether we're in recession. So we're going to have to wait for additional data to tell us the answer.
When you look at the massive decline that we had on Thursday in the equity market, what are you attributing it to, and should investors brace for that to happen again? Was that a one-time panic? Is that emblematic of the underlying fundamentals of the U.S. economy not being in line with where corporate profits are, with the performance of companies reflected in the market?
I think that because all of the 10 sectors in the S&P 500 posted declines in the most recent 4-day period, that it's a reflection of worries about the U.S. slipping into recession, not just worries about the banking community in Europe because of the continued sovereign debt woes. Right. So I would tend to say that we're not out of the woods just yet. This correction still probably has further to run. Maybe we won't get another 500-point down day on the Dow. But I think certainly that we could continue to see red arrows for a while.
How do you play this market then? Where are you advising investors to put their money at a time like this when you say we're not out of the woods yet?
Well, I have been advising investors to gravitate toward larger cap stocks because when the seas get rough, investors prefer larger boats. Go more toward the value side of the equation because earnings growth and valuations look more attractive there. Also gravitate more toward the defensive sectors, consumer staples, for instance, because the demand for these products and services remains fairly static and they tend to fall less than the overall market. And also look toward those companies that have consistently raised their earnings and dividends over the past 10 years, as seen in a quality ranking by S&P of A-, A, or A+.
But during the sell-off on Thursday, what we saw as a result was all the Dow 30 stocks down and down significantly. Take a company like Alcoa, right? This is a very good company in terms of being emblematic of the broader economy. They make aluminum, so it's in jets and it's in soda cans. So Alcoa was the biggest loser on the Dow, and that is a very big company. Is that really where people should be putting their money, in these big blue chips?
Well, I think the question is, when the market falls, are there safe havens? And the answer is no. That regardless of whether you are tagged as a defensive sector or as a cyclical sector, when the market goes down, there is no place to hide. Defensive simply lose less than the overall market does. Actually, if you're looking for one area that consistently rises when the market falls, that would be treasuries.
Right.
And so right now, with the worry still overhanging us as to whether the debt rating will be reduced for U.S. treasuries, I think investors are finding that there are very, very few places to hide right now.
The yields are still so low, whether you look at the 10-year, 2-year, or 1-month T-bill, but yet you still have people just in the last day and a half flocking to treasuries.
I think it's because investors at this point remember what happened in 2008, and they would much rather get a 0% return on their money, but feel that it is safe as compared with risking a minus 57%, which was what they experienced from December of 07 going into March of 09. So I think investors are really focusing more on capital preservation than they are looking to make a profit on that money.
Sam, thank you so much. Appreciate your insight.